Matt, my Twitter feed is going bananas over this major bank's clerical mistake. Look, the bank has already admitted its mistake to the SEC, and it's calculated that it will take a loss of nearly $600 million because of this clerical mistake. But I actually estimate that the fallout could be much larger if things really hit the fan. So it's nearly guaranteed that this bank will lose upwards of $600 million fixing this clerical mistake. But I also estimate that it could lose another $150 million annually in lost revenue. The bank is actually already 35% less valuable than it was earlier this year based on its market cap and share price. And if this bank goes belly up, another $33 billion in market cap could be erased from the stock market. So I've actually put together a trade to take advantage of this unbelievably unique situation. And I'll share with viewers today what that trade idea is. But first, I want to explain what the situation is. It'll take about 5 minutes, and then we'll get to that trade idea. I know the trade idea is not a short sell of this bank. So first, Matt, two important questions that we need to answer. First of all, could this bank's clerical error Control-Alt-Delete my grandmother's savings? And what will be the next shoe to drop in this British banking giant's saga, Barclays?
Okay, you got my attention. Are you really worried about your grandma's savings, though?
Yes, Matt. Of course, I'm certainly worried about my grandmother's savings. Look, she's in her mid-90s, and she and my grandpa worked very hard for every single dollar they have. In fact, I always think about my grandma's savings anytime I give advice to subscribers. And while not all of the trades I recommend are appropriate for my grandmother, I keep that in the front of my mind.
Okay, so I guess why is this clerical error, debacle potentially threatening to your grandma's savings?
Well, Matt, check out this section of a piece written in CNN Business. They just put it out. Capital Group, one of the world's largest investment firms and parent to the American Funds brand of mutual funds that is popular among millions of US investors and retirement savers. They just sold, get this, 399 million shares of Barclays. They held 399 million shares of Barclays stock, and they all just sold it in the past week. And this wasn't the only large holder of Barclays stock that absolutely dumped them. In the same article, another unnamed holder of the stock sold $599 million shares of Barclays on Monday evening. They did it in a block trade after hours with Goldman Sachs. And it is just incredible to see large block trades like this, selling out of Barclays.
900 million shares in a day. That hurts. So why are these large Wall Street investors, some of whom manage money for older Americans and retirees, like your grandma, for example, why are they bailing out of Barclays?
Look, Matt, no joke. It's all because of a clerical error. So here's what happens. Barclays has managed a product, and the ticker symbol for this product is VXX. It's the iPath S&P 500 VIX ETN. And basically, you've heard of the volatility index. When people are fearful, the volatility index shoots up, and when people are complacent, it drifts lower. Well, to be able to position yourself either to hedge your stock portfolio or to make bets on crisis plays, you can trade VXX as a ticker symbol from, prior to the past couple of weeks, you could trade this in pretty much any brokerage account. So to do this, Barclays has to, with the SEC, do what's called a shelf registration. And they basically say that, look, over the next several months and years, we intend to sell like $20 billion worth of this product. And that's the number that they chose. And they did that in 2019. And typically, anytime, somebody, a mid-level executive or mid-level lawyer keeps track of how much of that $20 billion limit they've sold. And anytime they get close to the limit, let's say like $18 billion, they'll just send the SEC an email and say, hey, we'd like to sell another 20 billion of this product. And the SEC will say, sure, just update your shelf registration and you can keep on doing business as you'd like. Well, somebody messed up at Barclays. It went on for over a year, and they just realized in the past couple of weeks that instead of selling $20 billion worth of this product, they sold about $35 billion worth of it. They almost went over their allowed amount by double. And when they realized this happened, they started putting out press releases that they were going to change the way that they created shares of VXX. And they obviously alerted the SEC, and they're trying to sort things out now. But again, this was a clerical error that basically is going to result in Barclays having to make right on these trades and buy back this product from the purchasers. And Barclays, the number they put out is upwards of $600 million that they'll have to directly incur costs for fixing this error.
But now you're suggesting that the fallout could actually be worse than that, right?
It could. The $600 million is a direct hit that they are almost guaranteed to take. But I've seen estimates that they sell upwards of $15 billion worth of this product per year. And if, let's just say, they earn a 1% fee on that $15 billion, we're talking about $150 million in revenue potential every single year that Barclays isn't offering this product going ahead. Not to mention, I mean, billions of dollars worth of market cap have already been chunked off of this company from those large block trades, those institutional investors that are bailing on Barclays. And, worst case scenario, if Barclays went belly up, it's a $33 billion market cap bank right now. So that's $33 billion that stands to get wiped out of the stock market if the worst case happens.
But do you think it's gonna go belly up?
Here's the thing. I don't actually think that Barclays is likely to go belly up over this. Look, Barclays has been around since 1690. I didn't reverse that. It's not 1960. They've been around since 1690. This is a big bank with a long history. A few years ago, I think it was 2017, they got into some trouble with the SEC, overcharging some customers for products. Might have been an innocent mistake, but my point is that these big banks, they typically rectify these situations by paying some fines and making right to the customers that they wronged, and then they move forward. So this is not the type of incident I believe that is going to put Barclays under.
Okay, so now the trade idea rather, that you talked about initially, I'm going to venture a guess, we're not talking about shorting Barclays, are we?
No, I don't think at this point shorting Barclays is the right trade. Maybe you can make some money on that, but I think that there's actually a better trade to be had. And here's what it is. So when Barclays started admitting that they made this mistake, they didn't come right out and say what they had done. All they said, they sent out a press release. It was on March 14th, on a Monday, saying that they would no longer create new shares of VXX. If you wanted to buy VXX, you could buy the note on the open market. You could buy from somebody who was wanting to sell it, but you couldn't buy it from an authorized participant or bank. There was no new share creation. That's kind of like inside baseball in the weeds. But in short, what that decision, the effect that had is that it meant that the market price of VXX became untethered from the price of the index that VXX is committed to tracking. So basically, it was kind of trading way off of its index value. And just actually, we'll put up a chart here. This is actually a chart of the premium in VXX. So if you compare the market value of VXX, which is up here, to the index that it's supposed to track, there is a 30% difference. The market price is higher. And that is the opportunity that I see us being able to take advantage of.
So I guess kind of explain this in layman's terms. You've put together this idea. And what does all this mean?
Right. So I think that the next shoe to drop, so to speak, with this Barclays saga is that Barclays will do a shelf registration with the SEC, resume creation of shares, and VXX will start trading as it did prior to March 14th. Now, a lot of people are speculating that Barclays will fold VXX. They'll close down the product altogether. There's even a Financial Times piece that ends with the very last line is saying VXX may be the sacrificial lamb for Barclays, their way to exit the structured notes business. And I think that the pessimism around this situation is probably overblown. So again, my thought is that Barclays will make things right. They'll file their shelf registration with the SEC in the next several weeks or months. And basically, they'll be able to create new shares of VXX like they did just normally. And when that happens, the share price of VXX on the open market is going to collapse down to the index value.
So that's interesting. What you're saying is it almost guarantees that the drop is going to happen?
It does. I mean, this is not a risk-free trade. It doesn't guarantee that will happen. Barclays could go belly up. They could decide to shut down the product rather than shutting down rather than filing their shelf registration. But look, again, they've sold $15 billion worth of this product annually. And again, if they make a 1% fee, it's in the ballpark of that. If you look at the exchange traded product and the structured notes they sell through other intermediaries, but we're talking about $150 million worth of revenue annually. And why would a bank like Barclays forgo that type of revenue and walk away from that over a clerical error that they could correct?
So you've talked about this is not a risk-free trade. So what is the trade, Adam?
Okay, so the trade is an options trade. So sorry, grandma, this is not for you. This is probably not a trade for my grandmother. But what I'm thinking is I'm looking at options to trade this scenario. The great thing about when you buy an option contract is that you can never lose more than you pay for that contract. And the types of contracts that I typically recommend in my trading services are rarely more than a few $100. Okay, so you're putting a few $100 into an options trade, and if it doesn't go well, that's all you've lost is a few $100. So the one I have in mind at last glance was trading for about $200. You could buy the contract for $200.
Okay, sounds great. What is it?
All right.
I'm just pointing it right. I'm just hitting you right with it. What is it? Tell me what my appetite is running amok here.
It's time to reveal the idea. So I'm looking at the June 17th of 2022 expiration. So those expire in about 2.5 months. I'm looking at the 19 strike put options on VXX. So basically it's a bet that shares of VXX will fall back lower and start making money on those 19 strike put options.
This is basically, if I understand right, you're putting that $19 strike because that's where VXX should be at without that big 30% premium it's at right now.
You catch on quickly, Matt. So right now, VXX, we're recording this on Friday afternoon. In the open market, shares of VXX are trading for about $25.50, give or take. And the index value as published by Barclays as of last night's close was $19.38. So basically, if tomorrow Barclays came out with a press release that said, look, we've cleared everything up with the SEC, we're now registered, we've got our shelf registration updated, we can create new shares, the market is going to realize that 30% premium is completely erroneous and it will evaporate. So shares of VXX on the open market should collapse from whatever they are trading at when that announcement comes back down to the index value. So the other thing about VXX is structurally, it's mechanically designed to go down over time, the way it rolls contracts in the futures markets. Again, inside baseball, in the weeds, doesn't matter. But I think there's a lot of upside potential in this trade.
Now, it's interesting. I want to look at the other side of things. The downside, if this bet doesn't work out, if say things don't even out, we're looking at a downside of give or take a couple $100. Is that what we're thinking here?
That's the downside. If somebody makes this trade buying the 19 strike put options, June expiration on VXX for about $200, and VXX goes to the moon or something happens, the product gets shut down. The most you could lose on this trade for buying that put option is about $200, give or take whatever you actually pay for it. Of course, the other downside is that I'm probably going to get made fun of by a lot of people in the comments below in this trade. So it's, again, not a risk-free trade. It's not a guaranteed trade, but I think it's an interesting idea on a unique situation.
Now, circle back. What's the upside here?
Well, that's what I love about buying call options. When you buy a call option, your risk is 100% limited. You cannot lose more than minus 100%. You can't lose more than what you put into that stock option that you buy. The upside, however, is completely unlimited. And in my trading services, we routinely make profits of 200%, 300%, 400%, and even more. So when you have that, we call it asymmetry of risk and return. You can't lose more than 100, but you can gain 2, 3, 4, 500. And that's really, I can't say exactly what the upside on this trade is, but I do think it's well, many orders of magnitude above what the potential risk is.
But you do think that that kind of upside, that 2, 3, 400% is possible with this trade?
I do, absolutely.
Okay, so what else can people? Where else can people learn about the different style of options trading that you do?
I got you. Well, Matt, you're the one that helps me put these together, these videos together. I don't know how to actually add links to the videos, but I hope that you'll point viewers to today's video to my home run profit service. Home Run Profits is a service that I've been running since 2012, so 10 years now. We buy options. Most of the time we buy call options because I'm an optimistic, opportunistic, bullish, most of the time investor. So we do buy mostly call options, which are bullish bets on individual stocks and ETFs. Most of the contracts I recommend, you can buy them for a couple or a few $100s, and we target gains of 100% to 300% or more. So that's certainly, if this type of idea is interesting to viewers today, that's what they should check out.
I think something else to add to that, and we will put a link up top to how you can find out more about Home Run Profits. But it's also kind of a fun service to be a part of. There's options can be somewhat complex and can appear to be convoluted, but Adam, the way he does it, it's very simple, very easy. Follow a very simple system, and it actually is quite fun, especially when you're cashing in gains of 200, 300, 400% like we had before. So we'll certainly put that link up top there, Adam.
Sounds great. Thanks a lot.
And I think we'll kind of, put an end to it. That's a lot to kind of digest. But I do want to remind everyone to make sure you click that subscribe button. And if you do like the video today, give us a like, write a comment. We'd love to hear what you have to say. You can do that on any of our videos that we have on our YouTube channel. And of course, we're going to be back again next week for more with Ask Adam Anything, because I always make sure that I get Adam each and every week. Make sure to leave your comments, your questions below. You can also email us any questions you might have, either from myself, Adam, or Charles Sizemore. That email address is feedback@moneyandmarkets.com. We'll drop that right there. And he is Adam O'Dell. I am Matt Clark, research analyst for Money and Markets. Until next time, everyone, safe trading.